Welcome everyone, Luke Jaster here from Big Picture Trading, and today I wanted to help you get started with options. We'll be going over the basics, and then at the end we'll compare the difference between owning the shares of a company versus owning the options. And you'll be able to better judge for yourself if options are risky or perhaps a risk management tool. Let's dive in. To help understand options, you really need to understand four things. First, options fundamentals, such as what are options, types of options, contract specifications, including strike price and expiration dates. Second, exercise and assignment, rights and obligations, American style versus European style options. Third, options pricing and the variables. Fourth, time decay and volatility, intrinsic value versus time value, and the options chain. And finally, in this presentation, at the end, we'll run a few scenarios comparing owning the options instead of owning the stock. What's the difference? Well, you're going to have to stick around to find out. I hope that sounds good to everyone. Let's begin with options fundamentals. What are options? Options are a contract to buy or sell a stock in the future at a specific price over a specific period of time, or an arrangement between two parties to buy or sell shares for a pre-arranged price by a certain date. So there are two types of options. Call options. Owning a call option will make you money if the stock goes up. It's like being long the stock. Or there are put options. Owning a put option will make you money if the stock goes down. It's like being short the stock. An easy way to remember this is you call somebody up and you put the phone down. So call up, put down. I hope that's clear to everyone. Rights and obligations. These are dependent on if the option is a call or a put, and if you are the buyer or the seller. If you are the buyer of an option, then you pay for the right, and we'll get into the details of rights later. But if you are the seller of an option, you get paid to take on an obligation. Let's look at call options a little bit closer. A call option buyer pays for the rights to buy a stock for a specific price over a specific time frame. Remember, I buy calls because I think that something is going to go up in value, right? Call up, put down. I'm going to repeat that over and over throughout this presentation. We got to kind of hammer it into everyone's heads. What about if I sell a call? I get paid to take on the obligation to sell a stock for a specific price over a specific period of time. There are many reasons why people will sell options, but that's kind of beyond the scope of the basics in today's presentation. The important thing to understand is that if you sell an option, you're getting paid to take on an obligation. And that obligation in this case is to sell for a specific price over a specific period of time. Let's do an example. We'll use a transaction that most of you have probably conducted in your life. But instead of using your standard purchase agreement, we're going to use an option. So let's imagine we have two people. We've got Susan, the seller, who wants to sell her Corvette for $10,000, and Barry, the buyer, who wants to buy Susan's Corvette for $10,000. But Barry thinks the Corvette is actually worth $15,000. So instead of just paying Susan $10,000, Barry proposes that he'll pay Susan $500 for her to guarantee him the sale price of $10,000 for the next 2 months on her Corvette. So if he buys it, he still has to pay her the full $10,000. And if he decides not to buy it, Susan still keeps the $500. So it's not a deposit. For her, it's an extra $500 either way. That's the most important thing here. So if Barry finds a buyer for the $15,000, which is what he saw in several Auto Trader magazines, he can exercise the right to buy the car for the full $10,000 and make himself a profit, which in this case would be $4,500. Remember, he sold the car for $15,000. Out of that $10,000, he had to pay Susan $10,000 for the car and then $500 for the contract. So he's got $4,500 left. And on the other hand, if it turns out that Susan's Corvette is actually her ex-husband's and he never changed the oil and the engine needs to be refurbished and the transmission is shot, essentially the car is actually only worth $7,000, Barry actually has the right to walk away and lose nothing more than the $500 that he paid for the option. I hope that's clear to everyone. If not, then we'll do a few more examples during the presentation. Let's look at the other type of options. Put options. So here we have a put buyer. Remember, a buyer pays for the rights to sell a stock for a specific price over a specific period of time. Remember, you buy puts because you think something is going to go down in value, right? Put down, call up. All right, just type it in to let me know that you guys understand. And again, there are many reasons people sell options. The important thing to understand is that if you sell an option, you are getting paid to take on the obligation to buy a stock for a specific price over a specific period of time. Let's do a put example. Anybody here have car insurance? All right, great. Well, I guess you guys really actually do know what a put is, so I don't have to teach you. Excellent. So my work here is done. Thank you so much. No, I'm kidding. Let's do an example. When you pay your car insurance company, what are you paying them for? You're buying an insurance policy for them to take on the obligation that if you smash up your car or someone's property, or if you hurt someone, that they are the ones that are going to be on the hook to fix it or pay, not you. So every year you are paying for the right to essentially sell them your damaged vehicle for a specific price, usually like the insured value, right? And over a specific period of time, over like the next year, because you've got usually an insurance policy on a vehicle will be for 1 year. But if you don't crash your car, you don't get your money back, do you? Because they are the option seller, or as we say, writer. They get paid to take on that obligation to buy your damaged car for a specific price, again, the insured value, over a specific period of time. I hope that's clear. Let's get into contract specifications. One contract actually represents 100 shares. So if you buy one call, you have the right to buy 100 shares. If you buy 5 put contracts, then you have the right to sell 500 shares. But the price displayed is per share. So an options contract with a price of $5 is actually $500 because it's $5 per share, and each contract represents 100 shares. So if you multiply the quote price of $5 by 100, you get 500. Does everybody see how I got there? Okay, let's move on to some key variables for options. The strike price. This is the price at which the options buyer has the right to transact the security. So if you buy a $15 call, you will have the right to buy the security at the $15 strike price. Okay, so the expiration is like when you purchase, again, an insurance policy. It expires on a specific date and you lose your right to claim damages, and the insurance company is off the hook, right? In the options market, we have weekly options that expire every Friday. These are actually relatively new. They've only been around for about a decade. And then there are monthly options that expire the third Friday of each month. And then also there's also these options which are long-term options, which are longer than 9 months in duration. Now, let's put everything together. So, here we have an option chain. An option chain is like a menu of options available. Here we have an options chain for stock XYZ, which is trading at $15. And you can see all the specifications. The expiration date for all three is January 2021. Then we have the strike price. Here we see the $14, $15, and $16 strike prices. And we can see it's a call. So that will give us the right to buy stock XYZ at what price? Well, that depends on the strike price. So if we buy the $15 call with an expiry to June 2021, what will that give us? The right or the obligation? The right. The right to buy or the right to sell? The right to buy. At what price? At the $15 strike price. And till when? Anytime between now and January 2021. And how much is this one options contract going to cost us? At $1.55 per share times 100 shares, one contract will cost us $155. I hope that's clear. If so, let me know. All right, level 1 cleared. 3 more to go. Next, we have options exercise and assignment. Exercise and assignment, this we've already touched on, but we just kind of used different words. An option buyer can exercise their rights, and the key word here is can. To exercise simply means that I act upon my right to buy the shares if I own a call, or sell them if I own the put. While the buyer gets to choose, the seller doesn't. They got paid. So they're simply assigned the obligation, which means they are forced to take on or deliver the shares. It's that simple. Now, not only are calls and puts, there are also different styles of options. This deals with settlements and what actually happens when a buyer exercises their rights or a seller is assigned their obligation. So let's look at American style options versus European style options. Most equity and ETF options are in fact American style. So in most cases you'll be following these rules for options. So please pay attention to this. With American style options, they can be exercised at any time prior to or at the expiration dates. This is really important to remember. So those January 2021 options we had in the last example, I can exercise that option any day between today and January 2021. Next, when you do exercise your right, the exercise involves the physical exchange of the shares, so you actually get the shares in your account. And of course, that means that sellers of options have an obligation that can be assigned to them at any point, not just at the date of expiration. Does everyone understand those rules of settlement? Great. Now, let's see what European style settlement options are. These are less common. They are mostly used for indexes. I'll tell you why in a moment, but here's really the important point. While European style options can be bought and sold at any time, they can only be exercised at expiration. There are lots of misconceptions about this point because people assume they are somehow stuck with the option because they can only exercise at expiration. And they forget that these options can be bought and sold anytime as long as there is a bid and ask price. Again, the only restriction is that you cannot exercise a European style option until expiration. And finally, when the exercise or assignment is acted upon, the settlement is for cash. No physical exchange of shares occurs with European style options. I mean, can you guys imagine owning one contract of the S&P, like the index, and exercising your option to buy at expiration, and you've got 500 different shares that are called into your account? Sounds like a disaster. Certainly a pain. What a mess. This is why I mentioned earlier, European style options are usually used for index options. Why? Because they're settled in cash. I think we got this. Let's try an example. So, let's look at a call option on Suncor. Will this be an American style or European? American, exactly. So we have a situation with Suncor trading at $22.75 at the 23 strike call out to January 2021 is for $4 per share. So we buy one contract representing 100 shares. So we as the buyer pay $400 for the call, and now we have the right to buy Suncor for $23 from now until January 2021. Let's look at the seller or writer. They receive the $400 in income, but they have now the obligation to sell us 100 shares for $23. Everyone with me so far? Say at some point between now and January 2021, Suncor goes to $25. Now, let's see what happens when we exercise our right to buy Suncor at 23. We pay the buyer the $2,300 for the 100 shares, and the shares are called into our account. It's as simple as that. 2 down, 1 more to go. Rather, 2 more to go. Let's get into options pricing. There are 6 variables that are constantly determining the right price of an option. First, we have the stock price. The price of the stock impacts the price of the option by building intrinsic value or equity, like a house. I'll get into more details a little bit later. For now, I just need you to understand that if you own a call and the stock goes up in value, the option will also go up in value. Strike price. The strike price will determine at what price you will be able to exercise your purchase. Having a strike price of $23 on Suncor or a strike price of $18 makes a difference. It's like saying, does it make a difference if I have the right to buy Suncor at $18 or $23 when the stock is at 25? Of course it does. Next, we have time. This is the number of days until expiration, at which point the rights and obligations expire. What you need to understand for now is that the further out in time an option is, the more expensive it will be to buy. Interest rates, this is a relatively advanced subject matter which is beyond the basics. What you need to know is, like with all interest rates, whenever you have interest, it plays a role. With options, if interest rates go up, it's good for calls and impacts puts negatively. The risk-free rate of interest also prevents things like arbitrage. and exploiting loopholes for options mispricing. Remember, the whole goal of all these variables is to right price. Moving on to dividends. For dividends that are to be paid during the life of the option instead of being paid those dividends, the option buyer receives a discount on the price of the option. And finally, volatility. The implied volatility of the underlying stock needs to be taken into consideration because the more volatile, the more expensive the option because there's more uncertainty, right? We'll get into all the details of volatility very soon. But what you need to remember about all these variables, their sole purpose is to constantly right price the value of each option so that it reflects as accurately as possible the related probabilities within the current market conditions. Let's get into some details. Let's figure out what intrinsic value is versus time value. Let's start with time itself and the impact of time. We've already touched on this. The general rule is the more time until expiration, the higher the premium. Like with those insurance policies, you get an insurance policy for a month versus a yearly policy. Which one do you think is going to be more expensive? The yearly one, right? This leads to our next point. The reason that the longer contract is more expensive is because time is a function of unpredictability, right? So the longer the time frame, the less predictable the outcome. And the final point about time is that the uncertainty decreases as expiration approaches. So as the time frame decreases, predictability increases and vice versa. Let's look at stock XYZ again. Here we have 3 options contracts listed inside the options chain, all at $15 calls with varying time frames. We have the July 2020, the September 2020, and the January 2021. So, what did we learn from the last slide? The more time until expiration, the higher the premium. Which of these contracts has the most time before expiration? That's right, the January 2021 contract. And if you look at the price of the premium, it's the highest out of the 3. Why? Because of the time frame. The contract with the most time has the most unpredictability. Therefore, it has to be the most expensive out of the 3. Right? It has 8 months of time. The July contract has 3 months of time left, so the premium is less. Remember, the more time, the more premium you pay, or the more premium you receive if you're the seller. And as time passes, the value of that premium erodes. Remember, uncertainty decreases as expiration approaches. Does everybody see that? All right, I think we've got this. So, that is time value. Let's look at the other component of options pricing, which is intrinsic value. I like to think of this as equity, sort of how you build equity in a home. An option also builds equity, but we call this intrinsic value. And how do we know what the intrinsic value of an option is? For a call, we take the current stock price and subtract the strike price of the option. So that's the stock price minus the strike price of the option. So let's say we have the XYZ stock and its current stock price is $20 minus our option's strike price, which is $15. So 20 minus 15 is 5, and that is our intrinsic value. We'll do another example in a moment. Let's see if you can figure out what it would be for a put. So, to calculate the intrinsic value of a put, we take the strike price of the put and subtract it from the current stock price. Remember, a put makes money on the way down, right? Put down, call up. So, if we had a put with a $25 strike price and XYZ was trading at $20, $25 minus 20 is $5. Again, what if the put was at the $30 strike price? Then what would the intrinsic value be? $10. $30 put minus $20 stock price equals $10. I'll show you a visual representation in a few minutes. Let's figure out the other component of an option, time value. To figure out time value, we take the option premium, which is just a fancy word for the cost of an option. Then we subtract the intrinsic value, and that gives us time value. And as we've already mentioned, time value erodes down to 0, right, by expiration. So when the contract expires, how much time value does it have? None. Here are some visual examples to help you better understand how these two concepts work together inside a call option. So here we've got a stock trading at $20. We have a $15 call option with an intrinsic value of $5. How do we get $5? Remember, for a call, intrinsic value is stock price minus option strike price, or in this case, $20 minus 15. But the call is currently trading at $6.50. So to figure out the time value, you take the price of the option or the option premium, which is $6.50, and subtract the intrinsic value, and we are left with the time value, which for this option is $1.50. Does everyone see how we got that? $6.50 minus $5 of intrinsic value gives us $1.50 in time value. And remember, this $1.50 of time value decays down to 0 at expiration. Okay, now why don't we try a put? Again, we have the stock at $20, so to figure out the time value of a put, we take the $25 strike price and subtract the $20 stock price, and we are left with a $5 intrinsic value. Now, we take the price of the options here. We take the price of the option. Here we can see that the put is currently trading at $5.95. So all we need to do is just subtract the intrinsic value from the price of the option, and we are left with the time value, which is, anyone? 95 cents. And what happens to that 95 cents over time? Yep, it decays down to 0 at expiration. How's everything going so far? Great. All right, now let's get into some more details regarding the strike price, which is static, right? That does not change. And the stock price, which is constantly changing. So as a stock is moving higher and lower, the option can move above and below the strike price, right? So let's say we have the $15 call option on XYZ. Can the stock go from 15 down to 12 and then back up to 17? Of course. So what does that mean for the option? Well, first, it's constantly being affected by the stock price. Then as the stock goes up and above the option strike price, it builds intrinsic value. We call that being in the money. The option has intrinsic value. Remember, calls make money on the way up. If the stock price is the same as the option strike price, that option is considered to being at the money. And finally, if the option strike price is above the price of the stock, that option is considered to being out of the money. Only in the money options have intrinsic value. For the put, it would be the reverse. Why? Because a put makes money on the way down. Yes, so your put would be in the money if the strike price was higher than the price of the stock. You guys are going to sound super smart after this. I hope everyone's keeping up. All right, here's some more clarity. Let's have a look at the option chain again for calls on the XYZ stock. So XYZ, which is trading at $15. So all of the contracts with a strike price below the stock price of $15 are in the money. These have intrinsic value, right? So that's the lightest blue there. Then all of the contracts with the strike price above the stock price of $15 are out of the money. These don't have any intrinsic value, right? Those are the gray ones. And finally, the contract with the $15 strike price, which is the same as the $15 stock price, is considered to being at the money. This contract does not have any intrinsic value either. So let's summarize. Time value erodes to zero as an option approaches expiration. Intrinsic value reflects the real value and does not erode with time. And finally, intrinsic value is directly related to the value of the underlying security, the stock, just as we demonstrated. Okay. Volatility is the last concept we'll be covering. Then we'll get into those comparative scenarios of owning an option versus owning the stock. Let's jump into historical volatility. Historical volatility is the average deviation from the average price on a given period of time. In a given period of time, which means that historical volatility is what happens in the past. You are looking at a chart, you're looking back in time over the past year to see how volatile the stock has been. What's been its daily average range? Or, if you want to get fancy, the annualized standard deviation of the past price movements. How much in the past year has this stock gone up or down? That is historical volatility, everybody. Is that clear? Great. Because we also have implied volatility. Now we are looking into the future. Implied volatility, or IV, sometimes represented as IVOL, is determined by the marketplace. That is all of us, right, who are buying and selling the underlying security. We're impacting its movement. Implied volatility is demonstrating the anticipated future volatility for all known information. So think of our XYZ stock, and let's pretend that for the past 3 weeks there has been very little volatility. But next week, they have an earnings announcement. It's not important that the historical volatility is low, because what is important is that earnings announcements can move the stock a lot. Implied volatility is looking forward to right price the stock, taking into consideration all available information. This helps forecast by the marketplace as to the magnitude, not to the direction, but of the magnitude of future price move. This just means that the market is indifferent to the direction. It's not bullish or bearish, but rather it is identifying the size of the move, not whether it's going up or down. I really need you to understand that, but rather how much is it going up or how much is it going down. And finally, implied volatility represents one annualized standard deviation, meaning implied volatility is based on a yearly time frame of one standard deviation. We will be talking about standard deviations in a moment. Let's first figure out how to interpret implied volatility. Let's say that we have a $50 stock. Okay, with an implied volatility of 20%, therefore the implied is $10 or 20% of a $50 stock. That means that if this was a 1-year option, the market is pricing in that over the next year, this stock is anticipated to have a price movement between $40 and $60 based on one standard of deviation, which is 68%. So it's pricing in a 68% chance that the stock is going to move between $40 and $60, which is 20% in either direction. 20% down from 50 is down to 40, and 20% up from 50 is up to 60. But the implied volatility is also pricing in that there is a 16% chance the price goes lower than $40 and a 16% chance that it goes above $60. Now you're probably asking yourself, where did I get this 68% and those two 16%? Did I skip a slide? The only reason I know this is because I know how frustrating this was to learn when I was learning options. Let's see if the next slide offers some insights. Here is the thing I really want you to pay attention to. This is the probabilities distribution bell curve. Let's see where I got the 68%. In the previous slide, let's see where I got the 68% in terms of the previous slide. So you see those two light columns right in the middle? Add them together. What's 34? We'll ignore the 0.1. 34 plus 34, you have 68. That is one standard of deviation. 34% in either direction because the market is agnostic. Remember, implied volatility is concerned with the magnitude of a move, not its direction. Beyond that, we have the tails of the curve, right? Which are the 13.6, the 2.1, and the 0.1. If you add all of those together, you get almost 16%. That is how I got the 68% and the 16. If you go to Google and type in standard of deviations, this will come up, this chart right here. Please note these numbers are derived from math. It's like pi, 3.14. One standard of deviation is 68%. If you don't get this now, do not worry. This is all calculated for you inside the options chain. I just want you to know what it is that you're looking at. Let's see if we can figure out this next slide. Our ABC stock is trading at $50. The implied volatility is 10%. 10% of $50 is $5. So now, what is one standard of deviation? 68%. So the market is pricing in a 68% probability that ABC will have a price range between $45 and $55 over the next year, and a 16 plus 16 is 32 chance, 32% chance of going beyond that range. One final example and then we'll move on. Let's look at this in the context of the call options chain. This is the options chain for ABX. If we plot the time value for each option and plot it as a bar, notice that the at the money option, the $22 strike one, has the greatest time value of all the options. And if we draw out the same graph horizontally, does that look familiar? It's the probabilities distribution curve. We are getting a little too advanced for option fundamentals. Like I said, if you don't understand, maybe Richard will make this video available for review. Or come by to Big Picture Trading. We've got a free trial that you can sign up for, bigpicturetrading.com, where you can better understand this. We've got boot camps and things of that nature that'll take you through this as well. Okay. We made it through all the concepts. Congratulations. Now let's put everything we've learned together and see What would be the difference if we bought a call option instead of the stock? And we'll go over 3 examples. Okay, here we are. Let's compare the idea of buying a call option instead of buying the stock. For our example, we'll be using TELUS with the T ticker on the Toronto Stock Exchange, which was trading at $22 on April 12th, 2020. Both of our investors are bullish on TELUS and believe that there's considerable upside to be had. We all know how to buy the stock, but let's review things on the options side and why even bother buying a call option. So, if we as investors are bullish on the stock, what kind of option makes money on the way up? A call. Remember, call up, put down. We're going to be using a call option as a stock replacement strategy. So we're not going to be leveraging. We will simply purchase enough option contracts to control the same number of shares as the stock investor. We'll demonstrate how our risk will be defined to the premium, meaning the cost of the option. And finally, please note that we as option traders will not be receiving dividends like the stock investor, but instead the dividends will be discounted into the option price. Is everyone following so far? First, let's look at buying the stock. Investor 1 is bullish on TELUS, buys 1,000 shares at $22. That will be a capital outlay of $22,000. And of course, Investor 1 is entitled to the dividends that the company pays. Simple, right? We're all familiar with this scenario. Now, let's look at Investor 2. We are Investor 2, who will be buying a call on the option. Who will be buying a call option, excuse me. Why calls? Because we are also bullish on TELUS. And calls, what do? They build intrinsic value on the way up. So, a 4-month call option out till August 21st of this year at the $22 strike price is $1.50 per share. We want to control the same number of shares as the stock investor, so we will buy 10 contracts because each contract controls 100 shares. And our capital outlay will be $1.50, so that's the cost of the option per share times 1,000 shares, that's $1,500. Does anyone remember the capital outlay of the stock investor? It was $22,000. We are outlaying $1,500 to control the same number of stock. Let's look at our first scenario. We have a strong bullish advance. We were right. TELUS goes up to $30 over the next 4 months. Both investors participate. They were essentially both long the stock. The call option builds deep intrinsic value and gives a stock ownership-like experience. Let's see a visual representation. Investor 1, who has 1,000 shares, those went from $22 to $30. That is an $8 gain a share for a profit of $8,000 on 1,000 shares. What about us? As Investor 2, with 10 calls controlling the same number of 1,000 shares at the 22 strike price, those calls would also make us 8,000, but we have time value. And what happened to that time value over the 4 months? It eroded down to 0. So we have to subtract $1,500 from our $8,000, which leaves us with $6,500, which is relatively comparable, I guess. Does everyone see how we got that? Let's try another scenario. In this scenario, the stock remains at the 22 price over the next 4 months. So in this case, Investor 1 keeps the shares as the price remains unchanged, And for us as options investors, the time value on the option erodes into a loss. For investor number 1, since there was no change in the price, there was no profit, no loss. For us, well, profit, I mean, they did get the dividend, so I guess we should have counted that. For us as investor number 2, the $1,500 that we paid for the value, the time value, has eroded to 0. And since there was no intrinsic value at the end of 4 months, the option is, well, worthless. This is where perhaps some of you may be saying to yourselves, aha, I knew it. Options are risky. Ooh, the stock investor lost nothing and we lost 100% of our capital, and we weren't even really that wrong. But there's still one more scenario to go. Let's see what happens next. In this case, the stock materially declines. We were wrong. TELUS declines from 22 to 15 over the next 4 months. The stock investor will remain invested at a loss. The option will expire with no value. But let's have a look at this final scenario. Investor 1, just like they profited on the upside, they felt the pain on the downside. In this case, we have a $7 drop per share for a total loss of $7,000. Investor 2, our options are worthless. But the loss we incurred could not exceed the cost of the options, in this case, $1,500, which was our maximum risk. Does everyone see that? In addition, please take note that investor 1, their risk is undefined. What happens if TELUS goes to $13 or to $10? The stock investor would continue to feel the pain, to incur that loss, where we, the options investor, could reposition at 13 or 10, right, with those strike prices, and be in a much more favorable position to move back up. And TELUS continued to struggle again, our loss would be limited to our capital outlay. I need everyone to understand this concept. Here's a quick summary of what happened. We, as the investor, as investor 2, we were able to control $22,000 worth of stock with only $1,500 call options. And what happened when we were both right? We participated at a comparable rate. The stock owner made $8,000, we made $6,500. When nothing happened, we lost our $1,500 and the stock owner gained the dividend. And when the stock materially declines, or materially declined, they lost $7,000 and we lost $1,500. That was our max loss. And we still had money to reposition. Many investors use options to seek leverage and extraordinary returns, but you can use them just as easily as a risk management tool. Remember the insurance example? You can also use options to harvest premium, remember, by selling options, and there's much, much more. So before I leave, please remember options do add a variable of needing to be right on the amount of time needed on the option. So with a stock, you can just pick a direction and hope the stock goes up or down, but with options, you need to be right on direction and time, because the premium is a decaying cost. The good news is that if we're wrong, your loss is limited to the cost of the option. Does everyone understand that? And options can be purchased in registered accounts, so hopefully that will offer you some additional strategies you can implement inside your RRSP to, help grow your nest egg or whatever you'd like to do. Thank you very much. This has been my first presentation for the Montreal Exchange. I'd like to thank them for the opportunity. I'm Luke Jaster from Big Picture Trading. If you would like to trade options with us, we invite you to bigpicturetrading.com for a 14-day free trial. Thank you once again, and I apologize that we didn't have time for questions, but I really want to make sure we go at a nice slow pace so that everyone can understand everything. Cheers, everyone. Have a great day. Bye-bye.